We ready to go?
Yep.
Awesome. Good morning, everybody. I'm Mike Kazarian. I'm with Vine Group Mortgage Alliance. Tyson, wherever you are, great job. I mean, to what he said, like, I would recommend that you definitely talk to accountants. Make sure you talk to your lawyers. Obviously, you're dealing with professionals. I think it's important to deal with people that are specific to their field. I do mortgages, and that's where I'm going to help you. So let's get started. So who are we? I'm with Vine Group Mortgage Alliance. Sorry, how do I go back here? Oh. How do I go back here, Alex?
Just left.
Okay, so Vine Group Mortgage Alliance, we're the #1 mortgage broker in Canada at Mortgage Alliance for the last 6 years. We fund about $2 billion in business last year. I focus a lot on investors. I focus on first-time home buyers, like commercial. We have a commercial division that we work with as well. I'm gonna say, first of all, these events, like as much as information that you're gonna get in a very short period of time here, it's so important for you to network with the people because this is where you're gonna learn a lot. We deal with over 75 different lenders. I have no preference to any one lender. We're gonna go wherever it makes sense for you. My background, I worked at TD Bank for 21 years. I worked at RBC for 4 years, and I've been a mortgage agent for 8 years. I'm gonna just fly through these pretty quick. Bank versus mortgage broker. So for people that are new to investing, like really you need to determine who you're gonna work with. Build your team, build your real estate agent, build your lawyer, build your mortgage broker or mortgage specialist, whoever you're gonna deal with. And I'm gonna say that the difference between, and there's other mortgage agents in the room here, the difference between us and dealing with your own bank is we deal with multiple lenders with no preference to any one. When I was at RBC, very restrictive. I got one mortgage product, one rate. If I can't get the deal approved, there's nowhere for that client to go other than to someone else. So I recommend that you really, if you're dealing with your own bank, ask them if they're investor focused, and because you really want to understand, or they really need to understand what your goals are. If you're looking to grow your real estate portfolio from 5, 10, 20 plus properties, you need to work with somebody that's going to get you there. We do what's called a pre-position, so we're going to fully underwrite your deal up front. We're going to get your down payment docs, your income docs. We're going to get everything up front. So as an investor, it's so important for you to know how much you qualify for, not just for this property, but for your next property. So we're going to do that. Whereas versus a pre-approval, when you go to your own bank, they're going to do a pre-approval. They're going to maybe not ask you for many docs, and they're going to say you qualify for X amount. I can tell you, I've seen it so many times. I've had clients come to us. They put an offer in on a property, they went in firm with no financing conditions, only to find out that they don't qualify. When they came to us, and we're like, yeah, you don't qualify. I don't know why they told you that. So very important to get a pre-position done. Right now, the broker space, only 40% of buyers or borrowers are using mortgage brokers, and that's growing. So a lot of people are really tied to their own bank still. Current lending conditions, I mean, we all know it. If anybody's tried to borrow money recently with the current stress test rates, we have to use 2% above the contract rate. So if you're getting a 2, 3, 4, 5 year fixed rate, they're in the 5% range. So we're qualifying you at 7.5%. So your purchasing power is definitely a lot lower than it was pre-pandemic. So we need rates to come down. But the beauty of that too is that real estate prices have come down. So we've done an analysis. We can look at certain areas and go, does it make sense for you to buy? But I think any real estate agent here will tell you that it's always a good time to buy investment properties. Real estate or lenders right now too are limiting their amount of properties that they will lend on, and I'll get to that in a minute. So our blueprint, so really important to figure out which lenders you're going to use first if you plan to grow your real estate portfolio. So typically what I like to do, so I like to look at Scotiabank usually for the first 4 properties. Most lenders will have like a 4-door limit, and then basically they won't lend to you anymore. So what I typically do is I would go to Scotiabank for the first 4. I would do a STEP product, which is their secured line of credit product that allows you to access the equity as you pay down your mortgage. Then I would go to TD Bank for the 6th property. Beyond that, I don't have on here, but Simply Financial, we work with Simply Financial, which is CIBC. We can do up to 10 doors with them. And they're good. So every lender has a different criteria. Some lenders will require us to do debt service ratio calculations. We're gonna do an investor worksheet and to determine, whether you qualify. So beyond the 6th door or 10th door with Simply Financial, we also deal with Desjardins. They're a credit union. They're in Ontario, they're in Quebec, and they will typically do up to 12 doors. They used to have a policy where they didn't care how many properties you had, but every lender is starting to tighten up on that. They'll lend up to 1.25 million, so about a $1.5 million in purchase price. Again, we do a debt service ratio calculation to determine, what you qualify for. So beyond that, once you get past your 10, 12 doors, then we're gonna look at alternative lenders such as Home Trust, Equitable Bank. We're also gonna look at Optimum and Wealth One. They will do up to 16 doors. So really, depends on where you want to go. And then beyond that, we're going to look at commercial properties or commercial lending. And there's some commercial, Alex here from Bank of Montreal, so he could talk to you about that. Lending options, I briefly touched on this. So again, we're going to look at the banks usually first. Scotia TD Bank, they're familiar, everybody knows who they are. They usually have competitive pricing. You're going to pay a little bit higher interest rate on an investment property versus your principal interest or principal property. And I'll say right now, like Scotia Bank right now, their pricing isn't the greatest, so I may not go to them first. Monoline lenders, this is great for first-time home buyers and people that are buying their primary residence with less than 20% down. So if you're not buying an investment property, monoline lenders are usually funded through the banks. AMCAP, RFA, First National, there's so many out there. So they get funded through the banks. Their interest rates are typically lower on high ratio mortgages. So anything with less than 20% down and under $1 million. And I don't really want to touch on that too much here because this is about investing, but for anybody that's looking to buy their first home, we can talk about that another time. Credit unions. So again, I talked about Desjardins. They're great once we, get to a point where we're around 8-10 properties. If you're buying in remote areas, like I have clients that I have one client, he has 50 properties, he has a mortgage on every single one of them. And it blows my mind to think, how the heck did he get there? He used a lot of local credit unions. So if you're buying remotely in small towns, knock on the door, go to these local credit unions and talk to them, build relationships with them. Talk briefly about alternative lenders such as Equitable Bank and Home Trust, Optimum, and Wealth One. Again, they're great if you don't qualify through the A lenders. So the A lenders being banks, credit unions, and they're great for self-employed individuals. So Home Trust, Equitable Bank, they're going to look at your gross income, not your net income. So if you're self-employed, you pay yourself a modest income that's not going to support the debt service ratio. We're going to look at your 6 months business bank statements. We're going to incorporate some expenses in there, and we can use your gross income. And also with the alternative lenders, they have a much higher debt service ratio calculation. So usually with the banks, you qualify for up to 44% of your income. So let's just say you made $10,000 a month, you had no other expenses. The maximum debt that you could have is $4,400 a month, 44%. With Equitable Bank and Home Trust and other lenders, they'll go 58, 60%, so they'll do extended ratios. So important for self-employed individuals. The caveat with the alternative lenders, they do charge higher rates. They're going to charge you a fee of anywhere from 1 to 1.5%. But I'll say this, for a lot of self-employed individuals, some people get caught up on interest rates, and I would say don't get caught up on interest rates. Would you rather pay the government $30,000, $40,000, $50,000 in taxes, or would you rather pay an additional $5,000, $6,000 in interest per year? It's a no-brainer. I have very wealthy clients that we have to go through alternative lenders. They make a lot of money, but they don't show it on paper. They have assets in the 20, 30 million bucks, and we still have to go through alternative lenders. And then there's private lenders. Private lenders, well, we need them. I mean, the loan-to-value ratios that they will do, depending on the property area, is usually 65 to 75%. So you're going to have to come up with a bigger down payment. Right now, I'm seeing a lot of pre-construction clients that bought 2-3 years ago that don't qualify. right now with the current stress test rates, or they moved out of the country, they're now non-residents, they have to put down additional money, they're probably gonna have to close with private lenders. So private lenders, 8%, actually, that's probably pretty low right now. You're probably looking on a first mortgage about 10%. On a second mortgage, you could be 12, 13%. And depending on the size of the mortgage, they're gonna charge you anywhere from 2% fee to 4 or 5%. If you're doing a smaller mortgage, like they wanna get paid, they're not gonna do it for $2,000. So, but if that's the only way for you to close, then you're gonna close. Private lenders, usually we only do 12-month terms. So we need to have an exit strategy there. So you gotta figure out, are you gonna qualify for another mortgage through an A lender? And we gotta crunch those numbers, or are you gonna sell the property? You know, if you've already got your built-in gains and you're like, okay, let's get out of it, if the numbers don't make sense because I'm paying 10, 12%, then you need to figure out about trying to exit that. Construction, financing, we do those. Flips, I think Tyson briefly talked about that. Obviously the rules are changing every day, so flips are good for private lenders, but then you're gonna have to talk to your accountant and figure out what kind of taxes you're gonna be paying on that now. So is now a good time to buy? Again, I think Tyson and Alex will tell you that it's always a good time to buy. It's just about picking the right area, the right location, and the right property. I have clients from BC to the East Coast. We do financing in Alberta. I did construction or a deal in Saskatchewan the other day. So we're all over the place, but it's really about making sure that you understand the area, dealing with a real estate agent in that area, whether you're buying in Windsor, great opportunities. And so I don't know if I talked about Desjardins, no, I'll get to this in a second. So down payment, I think Tyson kind of briefly touched upon this as well. So you're looking at a minimum 20% down. Typically cannot be gifted funds. So you have to have your own resources, and it cannot come from lines of credit. It has to come from your own investment. Desjardins will allow gifted funds, so that's one lender that will. I do recommend, well, we are going to require 90-day history, so we're going to need to see all your bank sources, if it's coming from your TFSA, RSP, investments, where the funds are coming from. We need to verify the full paper trail. If you're doing a joint venture, make sure you open up a joint bank account or have those funds in your account if, say, somebody else is giving you the money for the down payment and you're gonna get the mortgage, because maybe your investor or your partner already has too many mortgages, they don't qualify, but you qualify, but you don't have the income. Make sure that those funds are in your account, because anytime there's a deposit made into your account, any lender is gonna ask you the source of that income, and if you say, oh, that's my business partner, the deal's gonna be dead. So set up a joint account, make sure those, or if you have the funds in your account 90 days, then that should be fine. I briefly talked about non-residents. So again, I have some pre-construction clients now that moved out of Canada. They put their 20% down, and now they're ready to close. It's like, no, it's 35% now. They're like, well, now I gotta come up with another $70,000 down payment. Yeah. So things you need to know if for real estate or investment properties, if you're buying a duplex, triplex, whatever it is, make sure that it's legal and conforming, and your real estate agent will walk you through that. I'm gonna say, like, if it smells like a student property, if it looks like a student property, it's a student property. More difficult to get financing for student properties. So and look, it's all gonna come down to the appraisal. I've done a property in Kingston. It was it was basically a duplex, but there were 4 bedrooms in each, and there were locks on the doors. So I said to my client, remove the locks on the doors before the appraisal gets done. So we make it look like 2 single families could live there. Yeah, boom, the appraiser comes back, they say it's a duplex, the deal gets done. I had a client, I had an approval with Scotiabank in Barrie. She was refinancing her property. The deal was approved. The appraiser went in and found mattresses everywhere. She had a nail salon, she had people living there. Had I known that, I would have told her to remove the mattresses. The deal got killed. So now she couldn't refinance. Maybe she was buying another property, another investment. So little tricks of the trade. I'm gonna say, make sure you talk to your mortgage broker, whoever you're dealing with. Tell them everything. You know, we'll figure it out. Touch briefly again, so 4 doors is maximum that most banks will lend on. Again, TD Bank will do 6 doors. Desjardins, this is beautiful. If you're buying in Windsor and you're buying an 8-plex, we can go up to 8 doors under the residential side. They do charge a premium, but and you can talk to your commercial advisor and see if that makes sense for you. But Desjardins is the only lender that will do up to 8 doors. Again, they're going to cap it at 1.25 million, so you may not even be able to buy an 8-plex in Windsor for that price. I don't know. When lenders look at buyers, we're going to look at your income, your net income, so whatever you're declaring. Whereas versus on a commercial, and we're not really talking about commercial lending here right now, but commercial lending, they are going to look at the asset itself. They don't look at your personal income. Okay, this is a big one: holdco versus your own name. So a lot of investors, their accountant will advise them to put it under a holdco, which is great because for tax purposes it makes sense, for liability it makes sense, but you're limited in terms of the amount of lenders that would actually finance under a holdco. And like I mentioned earlier, Wealth One and Optimum will do up to 16 doors. Scotiabank's only going to do up to 4 doors. Desjardins does not do holdcos. So you got to really look at that and determine, does it make sense for you? Maybe you put some in a holdco, maybe you do some in your personal name. And the problem though is some holdcos, it will actually show up on your credit bureau. Typically it shouldn't, because if it's under your corporation it shouldn't, but some lenders will report that. And if it shows up on your credit bureau, we have to include it in your debt service ratios. If it doesn't, then we don't include it because it's under your corporation. Purchase Plus Improvements, I love this product. I don't know if many brokers actually use Purchase Plus Improvements, but if you're buying a single family home and you want to convert it to a duplex, Purchase Plus Improvements, most lenders offer it. Basically what they will do is they will lend you up to 60 grand of the improvements. So you actually have to fund it yourself. It cannot include appliances, so if you're redoing the roof, the furnace, floors, kitchen, bathrooms, whatever it is, we get a contractor quote up front when you go in and purchase the property. Once the renovation is done, usually within 120 days after closing, they send an inspector out, they confirm that work's been done. If you put 20% down, so your loan to value is 80%, you're gonna get 80% of that 60 grand back. So you're gonna get $48,000 back, and it just gets added to your mortgage. So now you get that cash back, so if you use a line of credit to fund your improvements, or you borrowed money from family to do that, you're gonna get that back, and or now you have that money to buy your next property. Okay, so Purchase Plus Improvements, keep that in mind. So yeah, just success tips. Look, it's getting harder. Make sure you're prepared. If you have multiple properties, make sure you're organized. Make sure you have your T1s, your NOAs, your pay stubs up to date. Make sure you have folders for everything. If you have multiple properties, make sure you have your property taxes up to date, your mortgage statements, your lease agreements, so that when we look at your application, we're ready to go. We can analyze it and let you know what you qualify for. And that's it.
Thank you so much, Mike. That was
You're
very
welcome.
insightful. We have time for 2 questions.
So I wanted to ask you about the, how you said you could do the renovation and get that done.
Purchase Plus Improvements.
Mm-hmm.
Yeah.
So what is that about? I've never.
So every lender offers it. So again, so you get a contractor quote up front. So you got a client that's going in to buy a property. It's either going to be investment property, they want to convert it to a duplex. We're going to need to see that that's what you're doing. Or it's just you're buying a primary residence and you want to upgrade it. You don't really have the cash to do that. You're like, I want to buy this and I don't want to wait 5 years, whatever. So $60,000 is the maximum they'll do. So you get the contractor quote up front. You're going to redo the kitchen floors. We submit that to the lender when we submit the application. We say we're asking for $60,000 more. You're going to fund the renovations yourself. Once the renovations are done, then we're going to send an inspector out. They're going to see that the work's been done as indicated on the contractor quote, and then they're going to release those funds through the lawyer and add it to the
Oh,
mortgage.
but you have to have money up front to get that.
You do.
Is that
Yeah,
the
so
line
you
of
use your
credit?
line of credit,
Yeah.
use family, whatever you need to do,
Okay.
but then it's going to get added to the mortgage. So that's
They closed the deal, or the client would close the deal, and
Yeah.
then they would go ahead and start the process?
well, no, we need to have that contractor quote when we submit the application.
Oh, I
So
see.
we need to submit the application as a Purchase Plus Improvements.
So when you're getting your mortgage, you have to do it at the same
You
time?
do. You do, so I mean, you've gone into that house 2 or 3 times before you decide you're gonna buy it, bring your contractor in there, get a quote. And that contractor quote, I mean, it has to be from a legitimate contractor. That doesn't necessarily mean that they have to do the work. If you're a handy person, you can do the work. But we're gonna send an inspector and make sure that if you said you're putting in new hardwood floors and they were $7,000, that was hardwood floors are in.
And Mike, would you also have to qualify for the extra 60K?
Yeah,
Yeah, you have to incorporate that into your
If you
debts.
don't qualify, then you don't get it.
Yeah.
well, yeah.
Okay.
But like, look, we're increasing the mortgage by $60,000. That's not a huge amount.
Yeah.
So, but, you know, we're gonna determine that up front when we do the pre-position, so
Okay.
we're gonna say, yeah, you qualify for that extra 60 grand, or we're gonna say, no, you don't, maybe you only qualify for 30, whatever the case may be, right?
All right.
Is it with A, B, and union as well, or just A?
Well, those are A lenders, yeah,
Just A lenders.
yeah.
Okay. One final question. We want to be respectful of our last speaker's time. One last question, then we'll move on to our last speaker.
Just get a last question, right?
Yeah.
So, let's say you bought a property, okay, and can I get a mortgage with the equity that has been built in my property?
With that you're in your existing property?
Yeah, so let's say I wanna get some loan, and I don't have any credit, and I don't have anything. The private property that I have, and the equity has been built in that property. Now I wanna get a down payment based on that equity. Let's say it's like some cash flow.
Yeah, this is what everybody does, right?
So
So
refinance.
you've built up equity in your primary residence,
Yeah.
we're gonna refinance that, you don't have any cash, we're gonna refinance that, you obviously have to qualify.
Yeah.
We can go up to 80% loan to value, so let's just say your home's worth $1 million, you have a $400,000 mortgage. We can take out another $400,000, use that money for the down payment on the new property.
Oh, okay.
If your existing property you're gonna use as a rental property, then we're gonna do a fair market rent assessment on that, and we can calculate that to help your debt service ratios. But yeah, we're gonna look at both, we're gonna look at refinancing your primary, and then we're gonna look at what you qualify on the new one. And I would always recommend that you have a higher mortgage on your rental property for tax purposes, and then a smaller mortgage on your primary residence.
All right. Thank you so much, Mike.
Thank you all.